Okay, today I'm going to take you through Module 2 of the fourth edition of Financial Statement Analysis, and we're going to start off with a review of business activities and financial statements. So a lot of this will sound familiar because we briefly touched on it last week. The first learning objective in the module is a review of the financial statements, income statement, balance sheet, statement of stockholders' equity, and the statement of cash flows. The only one of these we didn't touch on in Module 1 was the statement of cash flows. We briefly identified the three major sections, but we're going to go a little bit deeper today. And again, this material should be familiar. This is covered in the prerequisites, but we want to make sure that we have a common understanding and foundation from which to build on for the rest of the semester. So, basic accounting equation, assets equals liabilities plus equities. This is the foundation of the balance sheet. Assets represent uses of funds, so remember that assets end up inside of our firm by the contribution of either equity holders or debt holders. We will borrow money or we will fund the firm with equity capital, and that cash is deployed in property, plant, equipment. If it's a service firm, you have laptops, you may have real estate, the general assets of the firm that powered to run the business and generate future cash flows. The assets are listed in order of liquidity on the balance sheet. Last week we mentioned that sometimes if you're looking at IFRS, International Accounting Standards, that can vary a little bit. Liabilities are listed in order of maturity, so you have your most recent liabilities first. That's important to an analyst because as we identify the risk that's on a company's balance sheet, the risk that's embedded in the company's business model, we need to know the timing associated with each of those cash flows. If the company has near-term debt coming due, then they need to have the cash on their books or be able to generate that cash from the operations of the firm in order to pay off that debt. Otherwise, they might find themselves in the crosshairs of their bankers or bondholders or what have you in arbitration or worst case bankruptcy. Okay. And I'll be moving through these slides pretty quickly. As I've mentioned before, I don't cover all the material on the slides, but all of the material on the slides and all of the material in the book is testable material. What I want to do is just highlight some of the, maybe some of the more confusing parts of the curriculum and add some color on that to the extent that I can. Change this color scheme here and see if I can do away with that error message for good. So assets, I think we're all familiar with what an asset is. Current assets, again, are those comprised of less than 1 year. As we get into some of our ratio analysis in subsequent modules, we'll differentiate between current and long-term assets. We'll get into a concept later in this module called net working capital, or the assets and liabilities that are on the balance sheet that are necessary to facilitate the day-to-day operations of the business. And those are key to our analysis because it gives us some idea of how much capital is just wound up in running the business. And every business is going to have a unique working capital number. Some manufacturing firms require a lot of working capital to propel those businesses, and other firms that are service-oriented require very, very little. Examples of current assets include cash, short-term investments, accounts receivable. Accounts receivable is always presented net. In another module, we'll get into the calculation of accounts receivable, how we reserve against future write-offs, against future bad debt expense. Generally, a company will have some history of what percentage of accounts go bad over time, and we use that to make a reserve against the accounts receivable presented on our balance sheet. Inventories, this is another number that can get a little bit confusing depending on how we categorize inventories. That'll be another topic of a later discussion as well. And then prepaid expenses, not one that you normally think of as an asset, but if we pay our rent in advance, then we've stored up payments that we won't have to pay in the future, and we list those as assets on our balance sheet. Let's look at a few examples of long-term equity, long-term assets rather, property, plant, and equipment, which I mentioned, long-term investments, intangible and other assets. Intangible and other assets is another one of those areas where we will spend some time on, and you'll find periodically some companies that have large numbers in the goodwill, large numbers in patents, trademarks, other franchise rights. These are intangible assets, very, very meaningful to a business. Take a business like Coca-Cola. I happen to be drinking a Diet Coke right now. The value of the liquid in this can is duplicable. Other companies can come to market with a similar soda, but the value in the brand that Coca-Cola has built up over the last 100 years is incredible. Their brand and their franchise is something very, very meaningful to the value of their stock, more so than probably the product that they have in the can. And as we record merger and acquisition activity through time as companies merge, we record the difference in what we pay and what we actually get in tangible assets and something called an intangible asset, which is labeled goodwill. So we'll talk more about that. Let's take a look at Apple's balance sheet here. You see the assets listed, broken down between current assets, long-term assets. Most of the major categories here: long-term assets, property, plant, and equipment. All told, Apple reported $176 billion in assets as of 2012, which is much higher now. Apple's one of the most profitable companies in the world, and also one of the largest. Cisco Systems. You can see the total asset number here at the bottom of the page, $101 billion as of 2013. Pardon me, let me go back there. I wanted to show the accounts receivable presented net of the allowance for doubtful accounts. So this accounts receivable number would have been $228 million higher if Cisco had not reserved that amount and deducted it from the gross accounts receivable number. So that's always presented net, and we get a little bit more detail about how this doubtful account number was calculated in the footnotes. So here's an opportunity for managers to influence the numbers that are reported on the balance sheet, because this calculation, this doubtful account number, the reserve number that we take against the accounts receivable, there's some discretion in how we calculate that, and we'll take a deeper look at that later in the class. But I like to point out so that you can be mindful of the different estimations and different assumptions that go into some of these metrics, because every one of them represents an opportunity for either error, an opportunity for manipulation, or an opportunity for a difference of opinion. And that's the critical thinking aspect about this class that's so crucial to financial statement analysis. We have to view these financial statements through an independent lens. We have to do our own analysis and come to a conclusion about what's most appropriate in terms of representing the true underlying economic reality of the business. So we examine very, very closely any number presented on the financial statement that has anything to do with an estimation or a forecast by management, and certainly the allowance account is one of those. Assets are reported at historical cost. We use historical cost partly because it's objective and verifiable. Last week we talked a little bit about why we don't mark assets to market, meaning that when the price of land or real estate, which is a good example, appreciates, why don't we take that asset and mark it up? One of the reasons we don't do that is because it requires an estimation. We don't have a readily identifiable, tradable market price for many of those assets. And here again, we want to limit the opportunity for management to influence those financials where we can. That's one of the reasons why we use historical cost in the recording of asset prices. Reliability, relevance, all of these things factor in. So knowledge-based assets not reflected on the balance sheet. Two examples that the authors give us here are pharmaceutical firms not reporting assets at full cost that they've expended. R&D is another example, but a company with a robust history of funding their R&D, that represents knowledge-based assets, and those knowledge-based assets are real. There's a library, there's a history, there's embedded knowledge in all of those expenses that management team, that company has deployed inside of their R&D effort in the past, and those are assets, and we can account for them. We at least have to be aware of them. If any of your target companies operate in the healthcare space, the tech space, in the pharmaceutical space, be aware of that. You need to be able to quantify the value in their pipeline because it probably doesn't show up on the balance sheet. Let's take a look at Disney's balance sheet here. Again, broken down by current assets, total current assets at $13 billion. You have television costs. Not exactly sure what that would be. If Disney was your target company, one of your challenges would be cracking open that 10K and finding in the footnote notes some more detail about each of these assets so that you knew exactly what it was, how it was recorded, any assumptions that goes into that. The authors here ask a question, where's Mickey? The market value of Mickey Mouse is a trademark that does not explicitly show up on the balance sheet, but you'd be hard-pressed to find anybody that didn't argue or didn't support the conclusion that there's huge value in those mouse ears. Mickey Mouse is a recognizable figure around the world. Certainly value there does not show up on the balance sheet. Apple's liability and equity. Here again, liabilities are presented in order of liquidity. So we start with current liabilities, accounts payable, accrued liabilities. We'll talk about accrued liabilities here a little bit more in this module, and shareholders' equities. So liabilities not requiring payment within 1 year, classified as long-term. Again, liabilities requiring payment within 1 year, classified as current. So that's the line of demarcation there. It's somewhat arbitrary. Know what it is. That's likely to be testable material. Accounts payable, accrued liabilities. Accrued liabilities can be like wages earned but not yet paid. So you get to an end of the pay period, say the pay period ends on January 2nd, but we have to wrap up our books on December 31st. So there's almost, maybe we pay bi-monthly or every 2 weeks. So there would be almost a full pay period that we owe all of our employees. Those funds have not yet been paid out, but we have to book a liability on our balance sheet before we can close the books. And we do that by recording an accrued liability, in this case specifically wages payable. There are many examples of recording accrued liabilities, and the one that the authors give us here are accrued income taxes, which would be reported as either taxes due, or you might also see that labeled as taxes payable. So the nomenclature here can vary company by company, and again, it's our job as analysts to have the wherewithal to know that we need to go to the footnotes, do a little digging, so that we can understand what can be minor nuances in the presentation of some of these accounts. Unearned revenues, so similarly, we can have expenses that have accrued but not paid out. We can have revenues that have been collected but not yet earned. So just like we can prepay our rent, if we are the landlord and we receive prepaid rent, that would normally be recorded as a revenue on the books of our business, our company. But since we have not yet earned that, since the revenue was paid in advance, we will record that as a liability on our balance sheet called unearned revenue. So these could similarly take the shape of advances from customers deposits, or deferred revenue and unearned revenue are similar terms there. They're interchangeable. You'll see them presented both ways. That represents a little bit of a challenge. We just have to recognize when we see it that yes, those terms mean the same thing, and they're recorded on the balance sheet as a liability. Short-term notes payable, current maturities of long-term debt, other examples of liabilities. Here's Cisco's balance sheet. You see there liabilities presented again in order of liquidity. Current accounts payable, income taxes payable, so on and so forth. Net working capital. Let me go back there. Okay, net working capital. presented as current assets less current liabilities. So if our current assets and our current liabilities match, then we have in essence funded what it takes to run the business on a day-to-day operating measurement with our current liabilities. So if we can take in current assets, so we have enough cash and inventory and accounts payable, and match that against those current liabilities, then it's not going to require any additional capital to be put up by either the management team or from the bank or another avenue. Operating cycle, this is a nice little graphic that our authors give us to show inventories becoming sales, sales becoming accounts receivable, fingers crossed, ultimately becoming cash, cash reinvested back into the business to purchase more inventory or settle some of the other accounts payable that we might have on our books. And this is referred to in the accounting cycle as the operating cycle of a business. Non-current liabilities, long-term debt, other long-term payables. Usually these are with bondholders or long-term debt that has been borrowed from the bank. Other examples might include mortgages here. Other long-term liabilities, pension liabilities, long-term tax liabilities. You see those take various shapes, sizes. Again, consult the footnotes for all the details with regard to each one of those when they come due, and specifically with regard to your target companies. Make sure that you're familiar with any covenants. And we'll talk more about this, but a covenant is a restriction put on the company by the debt holders. And basically this is just an agreement between the borrower and the borrowee, whereby the party loaning the funds says, yes, I will loan you the funds, but there's going to be certain strings attached. And those strings are called covenants, and they come in all varieties, and they can basically be anything. And it will be disclosed again in the fine print, the rules that the company has to adhere to, given that they've engaged in this transaction whereby they've borrowed money underneath these terms. And sometimes those covenants can be rather restrictive, and if you're not aware of them, then you can take on more risk than you realize if your company's in jeopardy of failing to meet one of those. Oftentimes they come in the form of debt-to-equity ratio analysis, meaning that if the company takes on too much debt or fails to generate enough cash or doesn't meet certain revenue thresholds, then all of a sudden that debt can come due, and it can come due now, and that can put a company in a little bit of a liquidity or solvency crisis. So look for those covenants and be aware of them. Sometimes you have to do a little digging to find them. You may have to specifically ask the management team what covenants they're subject to. Equity. So we continue to move through the balance sheet here. Equity is one of the major classifications. We have contributed capital and retained earnings are the primary two classifications of equity. Contributed capital comes from the owners, generally put up by the stockholders or the partners or the members, however the company has to be structured. And then retained earnings are those profits that are not subsequently paid out to the management team. Remember, not management team, shareholders. We'll use shareholders here as the owners of the business. When a company generates the profits, it's the owners that have right to those profits. Those profits become basically the property of the owners, and the owners can choose to pay themselves those profits via dividend, or the owners can choose to reinvest those profits in the business. So in a sense, they become reinvested capital or additional contributed capital. It just happens to be labeled as retained earnings in that sense. Okay, moving on. Examples of equity accounts. Equity, similar to bonds, can come in a lot of different varieties. I talked about the covenants associated with bonds. Well, equity, depending on who it's collected from, can take on a variety of different forms, just like a bond. So we can have common stock, which is the simplest form of equity, or we can have preferred stock. And preferred stock is equity contributed in a manner similar to a bond, and there's an agreement associated with that. and some common agreements of preferred stocks, or some common rules or covenants or stipulations of preferred stock are oftentimes that they get paid first. They get paid a dividend first. That dividend can be cumulative, meaning that if it's ever suspended for a year, then it's owed the next time dividends are paid before the common stockholders can get paid. Generally, preferred stock takes a senior position in the capital structure, so if the company does ever go bankrupt, these preferred shareholders are going to get paid before the common shareholders get paid. And then there are lots of other little stipulations and nuances to preferred stocks, and you really have to get down into the specific issue to understand the benefits and privileges that are due to those preferred stockholders. What they generally give up is full participation in the upside of the company. Additional paid-in capital, treasury stock. Treasury stock is stock that the company has elected to buy back from the market. Can generally be perceived as a positive sign when a company is doing this, although I will advise you to be careful, because it's not unheard of for a management team to embark on a buyback for the purposes of sending false signals or to try to pump up their stock a little bit. So just try to do a little bit digging with regard to the motives of the management team. Retained earnings and accumulated other comprehensive income or loss. I touched on this accumulated other comprehensive income or loss a little bit in Module 1, and we'll talk about it at length here in a few weeks, so I won't go into that now. Shareholders' equity section of the balance sheet is presented as follows. You usually have the major categories of equity broken out with the numbers of common shares issued and outstanding. And you also have paid-in capital and par value. Par value is an arbitrary number that's issued on each share of stock, and it's generally set very, very low, and there's no particular real reason for it. Those stock certificates will be issued at market price when a company either has their IPO or secondary offering, so by and large we can ignore that. Moving on to the income statement, here's our general format of an income statement. We're going to take revenues less cost of goods sold. Manufacturing firms are fairly conducive to our analysis because cost of goods sold is almost always presented in our textbooks. Many of you will select a service company to analyze this semester, in which case you wouldn't have a cost of goods sold per se. You would have other costs of bringing their goods and or services to market. So in my business, for example, I run a financial advisory firm, and we service a lot of clients, institutional clients, wealth management clients, and every one of those clients has a professional that they work with, a certified financial planner or senior plan consultant, as the case may be. Those professionals' wages represent a big part of the product that we deliver to market. So those service professional wages might be tantamount to the cost of goods sold for a manufacturing business like Ford or GE or Boeing or so on and so forth. So just recognize that the income statement format as presented by the text is typical for a manufacturing entity, and it will absolutely vary based on the business that your individual companies are in. Nevertheless, we do generally see operating profit after the expenses have been recorded that generate the typical revenues of a firm. That will net to operating profit, from which we will subtract taxes and interest to get down to net income. Let's take a look at Apple's income statement here. We see that in 2012 they generated $156 billion of sales. That cost $87 billion to generate for a gross margin of $68 billion. That brought us down to operating expense, from which we subtracted research and development, selling, general and administrative expenses that weren't directly attributable to the product. We get total operating expenses and then operating income, from which we subtract interest and taxes and record net income. So operating versus non-operating. As an analyst, we're concerned with operating income because generally operating means recurring. If we can identify operating income, then we're gonna be more successful in forecasting what we expect of the company in future periods. And as we reviewed in Module 1, first we gain a familiarity with the financial statements, we gain a familiarity with the business. On this slide, we're specifically gaining a familiarity with the operating income of the business so that we can forecast those financials. And once we have those financials forecasted into the future, we can value them. And once we have a valuation, we can make an informed decision whether that, if we're a bank, we're making an informed decision about perhaps whether or not to make a loan. If we're an equity owner, we're making an informed decision about whether or not to buy the stock, to sell the stock. If we work inside of a corporate finance department, we're making an informed decision about maybe some merger and acquisition activity or the strategic direction of the firm. The process is the same, regardless of user. Ultimately, we're trying to get information that's meaningful for the decision that we're making at hand. And to do that, we need to be able to differentiate between operating and non-operating expenses. There and again, operating typically being those recurring expenses, and non-operating expenses being those that we could either cut out, or they were one-time in nature, or not likely to recur again. Typically those fall into that vein. We do have to do some digging there and again to try to understand what generated those non-operating, but that's a little bit of commentary on the difference between operating and non-operating. You'll see here that non-operating expenses, the author's given us an example of interest expense. Interest expense, and then I just clicked out of it. Interest expense, you could view that a couple of different ways. If the management team has come to the conclusion that it's just embedded in their industry or inherent in their industry that they need to run their business with some debt, maybe to stay competitive. Maybe that's the standard operating model for most of their competitors. Then interest expense may become a recurring item in the forecast of those future financials. Technically listed under non-operating, but it has that recurring nature, so we need to be cognizant of that. There's a lot of questions that we need to be asking of these management teams about whether or not these expenses are likely to incur. This last one, clearly one-time in nature. Gains and losses from sales of securities. Unless you're in the business of selling securities, then that's going to be one-time in nature and something that we can be aware of when forecasting financials. Moving on, Cisco's income statement here presented for the last 3 years. See revenue, cost of sales, gross margin. Very typical looking income statement. Okay. When are revenues and expenses recognized? And this is key because oftentimes, especially companies that work on big construction projects or they have lengthy sales contracts, they can have very large contracts or projects that will influence the fortunes of their firm that may or may not be recorded, or liabilities that may or may not have hit the balance sheet at the time when we complete the accounting cycle and report the income statement, balance sheet, and cash flows. So if we report an income statement on December 31st, and we know on January 2nd or January 3rd that we're going to sign one of the biggest contracts that our company has signed in the last 10 years, is that going to have an effect on our business? Absolutely, that's going to have an effect on our business. But we have to know the rules behind when exactly we get to post those revenues to the income statement. And here's some general guidelines with regard to that. The revenue recognition principle recognizes revenues when earned. So not until we have actually earned those revenues are we able to recognize them. So for contractual relationships, that's usually when the services have been fully completed. And expense recognition is the matching principle. So when we report an income statement, the bottom of that income statement shows net income. And in order for that net income number to mean anything, we have to record the revenues that were generated, and we have to offset them against the expenses that were incurred to generate those revenues. And if we buy goods and services in a 12-month cycle, we may buy the inventory and not generate the revenue for another 6 months. But we have to match those two things together somehow so that we can present financial statements that are meaningful to the user. And the user, in this case maybe the common stockholder, wants to know what it took to generate that net income. What did it take to generate those revenues, so we can assess how profitable a company is. And that's called the matching principle. Profit versus cash. So that matching principle can create some mismatches, just because when we match those expenses to those revenues, we're not necessarily matching cash on cash. That's why we complement the income statement with the statement of cash flows. And those two financial statements really give us a full picture of the expenses that it took to generate the revenues. And then the cash flow statement tells us when those expenses incurred. So if we incurred the expenses and then didn't generate the revenues until the subsequent accounting period, well, the income statement will match those expenses with those revenues, but the statement of cash flow will tell us that one period vis-a-vis the second period looked much more quote-unquote profitable from a cash flow perspective. Okay, transitory items in the income statement. You're going to see tax expense, extraordinary items. These apply to income from continuing operations. The transitory items are those not expected to recur. So the authors specifically point out discontinued operations and extraordinary items. These are presented net of tax below income from continuing operations. And I would just caution you as an analyst here that if your target company has a history of reporting these transitory items, they may also have a history of trying to manipulate their financials, trying to manipulate the market, trying to talk up their stock, because it's not uncommon for a management team to, period after period after period, quarter after quarter after quarter, release earnings with the idea that at least a portion of those expenses are unlikely to occur in the future. And if you're a management team and you tell the analyst community that these expenses are unlikely to occur in the future, then a good analyst will credit against those expenses, meaning they will forecast future financials with the thought that those expenses will not occur. But if you look back and the management team has a 5, 10, 15-year track record of listing items in these transitory boxes here, you might scratch your head and begin to think, maybe these expenses are not so non-recurring after all. And if that's the case, then as analysts, we have to budget for that in the future. Meaning, this management team has a habit of recording expenses in those two line items, so let's budget for that. When we forecast our financials, let's make sure that we have something in there so that there's no surprises. Because if we're surprised, as an equity analyst, we're likely to see that stock tank a little bit, and that's not going to feel good when we're reporting year-end numbers to our boss or our clients. Okay, moving on. Let's take each of these transitory items one by one. Discontinued operations are gains or losses from a business that we've either discontinued or sold. Extraordinary items are gains or losses from events that are both unusual and infrequent. So remember those two terms. Unusual and infrequent. And a company's going to have to justify that an extraordinary item meets both of those two criteria to their accountants in order to be able to list those expenses underneath the extraordinary items line item and still receive an unqualified opinion from their auditor. So hopefully the auditor is watching our management teams closely and verifying that an extraordinary item really does meet both of these two criteria. Statement of stockholders' equity. We talked about this a little bit in Module 1, but it gives us a breakdown of all of the different contributed categories of capital, including contributed capital, retained earnings, treasury stock, so on and so forth. The authors give us a snapshot of Apple's statement of stockholders' equity. I'll let you review that on your own. And then let's move on a little bit to the statement of cash flows, because this is worthy of some time. The statement of cash flows is perhaps the most useful financial statement presented. Now, I had this thrown out as an interview question for one of my colleagues at one point, and it was posed as which financial statement, in your opinion, is the most important? And it was a leading question. The answer in that interview was the statement of cash flows, and the reason for that is that cash can't be manipulated. Cash is not subject to any accruals. Cash is not subject to any estimates. Cash is not subject to manipulation by and large. We know how much cash is in the bank, and at the end of the day, we're going to get a statement from our bank, and that's very easy to audit. It's very tangible. If we can, when we tie something back to cash, we can have a high degree of confidence in it. Back to that interview question, however, I would argue that while the statement of cash flows does give you some very, very valuable information, really to present any financial statement by itself is an inaccuracy. Think of the financial statements, at least the income statement, balance sheet, and statement of cash flows, as a three-legged stool. We need them all to have a good understanding of the health of a business. So the statement of cash flows here is broken down between operating activities, investing activities, and financing activities. And basically, we're going to reconcile the cash that we had on day one of an accounting cycle. So think of that as January 1st, 2016. We're going to reconcile that with the cash we have on our balance sheet January 1st, 2017, or rather December 31st, 2016. And every cash flow that comes into the business is going to be categorized as an operating cash flow, which is primarily the cash that is generated by our business. And investing activity, which is the cash that we spend on new investments, and investments come in the form of property, plant, equipment. Sometimes we'll buy a new business. Last week we talked a little bit about Berkshire Hathaway and the investment that they made in Burlington Northern in 2012, I think, whereby Warren Buffett and Berkshire Hathaway spent close to $40 billion on that railroad. That cash flow, huge cash flow, would have showed up in the cash flows from investing activities. Same thing goes if we were to sell or divest from a property that we've bought in the past. And then lastly, cash flows from financing activities. This is cash that flows into and out of our business from equity holders. So if an equity holder contributes capital to the business, that cash comes in. Or if a bond holder contributes capital to the business, meaning we borrow money from the bond market or we borrow money from the bank, or maybe we pay dividends. Those cash flows are going to equity holders and would show up in the cash flow from financing activities. On slide 34, we have an example of Apple's statement of cash flow. I'm going to let you review that on your own time a little bit. Same way with Cisco. Take a minute. Take 10 minutes. Take 20 minutes to look at the statement of cash flows, all the statements from your company. Look at them. Read them. Make sure that you can understand them. Have a grasp of the numbers. Just spend some time with those financial statements over the course of the next week. That is going to be key to understanding the businesses that you've selected to analyze this quarter, this semester. Okay, slide 36 is a nifty little chart that gives us some information on how the statement of cash flows is prepared. So we have the cash flow section listed on the left-hand side here, where we have net cash flows from operating activities. To get that, we're going to start with revenue, subtract expenses, and take net income. Net income's taken from the income statement. And then we're going to reconcile net income for all of those expenses and all of those revenues that showed up on the income statement that were not true cash items. So we have current operating assets and current operating liabilities. And we have any current operating asset that had a change in value is going to be a reconciliation item on the statement of cash flows. And you'll see that as you walk down the statement of cash flows and familiarize yourself with the adjustments that are taken from net income on the statement of cash flows. In the investing section, we're going to reconcile any changes in long-term operating and all non-operating assets. So we look on the balance sheet, these are balance sheet items. We look on the balance sheet and we see the, well, let me use that example of Berkshire Hathaway buying Burlington Northern again. When we look at the beginning of period balance sheet, we see investment in Burlington Northern, 0. When we look at the end of period balance sheet, we see investment in Burlington Northern, $40 billion. The difference between those two is $40 billion, and we can infer from that that $40 billion of cash went out the door as that long-term operating asset account increased in value. And then lastly, we take the net cash flows from financing activities and we reconcile the changes in account values to any long-term operating and all non-operating liabilities. Okay. Slide 37 gives us some more details on exactly how we do that. When we look at the balance sheet, we take any decreases in assets and we record that on the statement of cash flows as an increase in cash. We look at liabilities and equity. Any of those accounts that increase on the balance sheet are recorded on the statement of cash flows as an increase in cash. So we can take a very simple example there. We can take a very simple example there. One liability would just be a note from a bank. If the note from the bank increases in value on the balance sheet, then we know cash had to come in the door, and that cash will be reflected on the statement of cash flows. So star this slide and spend some time with it, because drafting a statement of cash flows is a little bit confusing as you reconcile asset accounts and liability accounts on the balance sheet. Work through this a couple of times in your mind. Familiarize yourself with how the changes in the balance sheet accounts can affect the statement of cash flows. This is a tricky one. This is going to take some time, so schedule appropriately. Make sure that you have a familiarization with the way these accounts move. Same way with slide 38 here. I won't take you through these one by one, but this is more detail on the information that we just went through. So you can drill in and look at receivables specifically, what that happens when they increase, what that means when they decrease, and how it's reported on the statement of cash flows. Star this slide. Know this slide. Okay, learning objective number 2 asks us to look at a financial statement template. This is part of your homework, so I'm going to leave this to your homework assignment. But the gist of it is that this financial statement template is taking us through the basic accounting equation, where assets equal liabilities plus equity, and looking at specific accounting transactions to understand how those transactions affect assets, how those transactions affect liabilities or equities, and how they will flow through the income statement, and ultimately from the income statement via net income to the balance sheet where they're posted as retained earnings. This is a nice graphic here on slide number 42, where you have the all of the different accounts and where they show up on each of the major financials. So you can track cash. Cash goes from the balance sheet, beginning of period cash. That's right. Hold on. Beginning of period cash, posted from the balance sheet to the statement of cash flows. The statement of cash flows reconciles beginning of period cash with end of period cash. End of period cash is posted on the end of period balance sheet. You can see contributed capital, retained earnings all flowing through to the income statement. Income statement flowing through to the net income to the statement of shareholders' equity. That in turn is posted to retained earnings. This is another one of those slides that's worthy of spending some time with. General accounting cycle, you will hear me refer to this from time to time. This is nothing more than the sequence of transactions being recorded, posted, posted to the ledger, recalled from the ledger, preparing financial statements, and then ultimately the accounting cycle is closed. Okay, learning objective number 3. This is the financial statement effects template, whereby we'll take a specific transaction and drill into exactly where that transaction hits each individual financial statement and the effect of that. So let's record $100 in wages. So we get to the end of the accounting cycle, we get to the end of the payroll cycle, and we owe our employees $100. So we're gonna take cash. Remember your debits and credits from. Hold on, bear with me just a minute. We're going to take cash and we're going to pay wages with it, and that shows up on our financials as a reduction to cash. And if you remember from your accounting class, that's a debit to cash that shows up right over here with the T accounts. And on our balance sheet as a reduction to cash. And on our income statement as a recording of wage expense. Wage expense will reduce net income by $100 in this case, and then that reduction to net income will flow through to earned capital as presented on the balance sheet. It's a little confusing. You do a couple of these, you get a feel for how this financial statement effects template works. And then after you do 2 or 3 or 4, I have found it to be very, very helpful in identifying how these statements work together and how they work together with each individual transaction. Okay, adjusting entries. These are important because analysts are required to understand that when we get to the end of an accounting period, the books don't look like the books are supposed to look yet. We have to adjust for those items like prepaid expenses and unearned revenues that we talked about a few minutes ago. And we do that by taking a look at the portion of expenses, for example, that have accrued but have not yet posted to our balance sheet. And we need to be aware of the accounting cycle, and we need to be aware of the accrued expenses and unearned revenues that may or may not have been recorded at the end of the period as an analyst, because sometimes there's an element of uncertainty that can come into these transactions. Prepaid rent. I'm not going to dwell on the financial transactions template here, other than just to say that it would be worth your time to take a deeper dive into each one of these. Unearned revenue. Here again, make sure you spend some time with these slides. Not particularly complex. You should be able to digest that on your own. If you have any stumbles, make sure you ask me in class, but I have every confidence you should be able to kind of work your way through that. Same way with this ice cream store exercise. Now that we've made it through the income statement and the balance sheet and the statement of cash flows, I want you to take a crack at this ice cream store Inc. setup. The exercise basically takes us through 5 bullet points and describes some of the initial transactions that the ice cream store goes through in the creation of the business. So, number 1 here. The Ice Cream Store Inc. was formed on October 1st with the investment of $90,000 in cash by the owners. Let's go back to our debits and credits here. $90,000 in cash went from the owner's pocket, so if I'm the owner, then it goes from Vern Cushenberry's bank account to the bank account of the ice cream store. And that transaction is recorded as a debit to cash and a credit to contributed capital. So now we have the beginnings of the balance sheet. We have cash on the balance sheet, and we have contributed capital on the balance sheet. You can go through 1, 2, 3, 4, 5 transactions here using that financial statement effects template and begin to sketch out the balance sheet and subsequently income statement for the ice cream store. That's what this exercise walks us through as we prepare these transactions. And I want you to take a crack at that on your own using that financial statement effects template. And just give me some feedback on how it goes. Here again, this is prereq material. You should all have a fairly common understanding, fairly good understanding of how these transactions should work. I understand that anytime you haven't used some materials in a while, you kind of have to refresh your memory, or dust off that accounting section of your memory bank. So if you run into any problems, let's address it in class, but I want you to take a stab at it on your own first. And all the templates are given there for those transactions. So work through that. And some more examples of apples here. I think that almost does it for Module 2. The authors always pause on analyzing global reports. Review some of these bullet points too. I mentioned in Module 1 that we're not going to spend a lot of time on international accounting standards, other than just to point out some of the big nuances. So that's definitely testable material. You might see it in a multiple choice type question, but that's nothing that you should be able to digest on your own. Additional sources of information. I want to take a good portion of next week's class and talk about some of these information sources. So I'm going to skip over the next few slides here. Analyst reports we're going to talk about in depth in class, and I may shoot another video because UMKC has some wonderful resources and everybody needs to know how to access those for your semester-long reports, especially. So I'll try to run through that in class, and then my experience has been that students will sometimes procrastinate those reports and get to the end of the semester and be kind of scratching their head a little bit, wondering how they dig up those resources again. So if I have that as a video or webinar, I think it would be helpful. So I'm going to try to do that. And that is Module 2. So I know these videos can be a little bit lengthy. I'm hopeful that we can use this as a good setup. I'll answer questions when we get back together again. Just gotta take notes. Let me know what was good. Let me know what we need to get in more detail. And I don't expect we'll have any problems picking up where we left off. So thank you, and I'll see you for Module 3.